different things done related, and you go tell somebody, hey, I thought about that, and 5 years go by, I wish I would have done something with that. That's where this begins, right? So you get into the first step of this is, I have an idea, I want to solve this problem. And that's really identifying the problem. The thing you have to ask yourself is there money in solving this problem? Because that's where the investment comes from, right? Does it make sense to solve said problem?
So, good business plan has 10 parts. A lot of people think business plans are boring. Some people, including investors, think they're unnecessary. I will tell you that I'm a business plan fan, mostly because it forces you, the person with the idea, to go through this process of validation and also test a lot of your assumptions. Now, you can go through the plan, you can go through each of these things and write your wish list of what you want and what you think it's going to be, and never test or validate anything and convince yourself it's the greatest thing in the world. Or you can take the time to do the research and have those assumptions tested, talk to other people who also test your assumptions, and make the necessary adjustments. And part of the reason that because the business plan is great is because it forces you to do the work. It forces you to get past the idea stage, right? When you're idea stage, that's not execution. That's this thing that I've had in my head. It could have been there for 6 months, could have been there for 10 years, you know. And if you never actually have to go through this process, then you never actually have to fail, right? It can always be this idea that has potential, that always has a chance of succeeding. But for us, the business plan has 10 parts. A good one, executive summary, which we can, you know, that's really the first thing people write, it should be the last thing. Your company description, go-to-market strategy, industry analysis, market analysis. See, right now we're talking about analysis. I can see people's eyes glazing over. Like, I get it, because, you know, none of that stuff's fun, but it is very valuable. Products and services, competitive analysis, your management and organizational structure, your projections, and if you're gonna go ask somebody for money, you know, tell them how much you need and what you're gonna spend it on.
And when you're going through all of this, it's a pain to like go through each step. But going through each step helps do the most important thing for every investor, which is mitigate the risk. Nobody's gonna give you money if you haven't mitigated the risk, right? Unless they've got so much they just wanna go light a bucket of it on fire and they don't care. Like, that's a good friend to have. You have that friend, share the name. I'd love to know that person. But ideally what you guys need to do is when you go down and you break down each one of these sections, it's really important to understand what you're going to do each step of the way, so you have a better understanding of how you're going to execute on whatever the business is that you want to solve. And it really is important when you figure out the total addressable market, and you go down each part of this, that you're realistic. That you're not like, hey, if I just caught 1% of this $45 billion market, do you know how big we'd be? Like, don't say that. That's just please stop right there. It's terrible.
So, executive summary. You know, a lot of people write 4 or 5 paragraphs on a page. You can do it that way. We write our executive summaries a little different. You know, one column has pertinent information and bullet points. The other one gives the highlights. The highlights section, investors want to know, and not just investors, but potential business partners want to know, what's your expertise? Am I getting into bed with somebody who knows something about what they want to do? Hopefully the answer is yes. So this is your chance to brag in bullet point form. Tell us why you're great, right? What's your education? That may or may not be relevant, right? Your education might be through the experience that you've gotten in this industry, that you now have solved this problem that a lot of people are saying, man, I wish we had X, because that would really make me happy. I could make 10 times more money. I could, you know, do this thing twice as fast, whatever it is. Again, you know, you want to put down stuff that you've done or you know that's pertinent to what you're doing. And then what makes you the right team, right? Hopefully it's more than just you. Investors invest in people, but they want to see more than one founder. They would like to see co-founders or a team. If there's 2 or 3 of you, you know, are you guys all doing the same thing? You know, what investors really don't like to see is 2 or 3 people with the same skill set. It means you're redundant. So try and make sure that your team fills gaps for each other. If John's great at finance and I'm not, and I'm great at analysis and John's not, well, that's a pretty good start, right? If we're both great at finance and we both are terrible at analysis, it's probably a terrible start, right? So
just to build off of that, so like, there's 3 things that matter when you're pitching. chain, especially at pre-seed and seed. Everybody know what pre-seed is? Anybody not know what pre-seed is? No? Okay. Well, I'm just gonna go ahead for anyone that might have been afraid to raise their hand. If you have an idea and you're like, hey, I want to build a thing to solve the problem, they go and raise pre-seed, right? The only way to mitigate the risk on that is the team. So your executive summary, the structure in which you've conducted yourself in the past, the track record that you have, the exits that you have, the ability to actually provide a return, an ROI on the investment, is 100% dependent on the team. And that's true for pre-seed and seed round. Because Series A is when you actually are priced, right? So that stage is, I have revenue, right? I can be measured. You can't be measured in pre-seed. You're still figuring out product market fit, right? You have no idea whether the product is even launched yet. You don't even know if people actually need it. The 100 people that hopefully you talk to are like, yeah, that sounds great. So you got maybe 100 potential clients, but at that point, you're still not measurable. Your metric for success is the team. Metric for success at the seed stage, you've got a product, you've started to execute, it is still the team. Because you still haven't figured out the customer acquisition cost, you haven't figured out like what the lifetime value is of that client, you don't know how long they're gonna be around. So still the investor's gonna be looking at you. Even if it's friends and family, you have to understand that each person you talk to, you have to be able to mitigate their risk or they're not gonna cut you a check. That's 100% the problem for every early stage founder, super early stage founder. So, oh, and what makes you the right team? That's the answer to that question. Why are you the right team? Why should I give you money, right? Why should you get people to follow you down this crazy path that is startups? Like, seriously, I've had a lot of CEOs, right? I've been a CEO, not a good CEO, terrible, because I'm a mess. But I've had a lot of CEOs, right? Some of them were amazing. I followed them at the ends of the earth. And 2 of them have had multi-billion-dollar exits, which is just insane to me. But many of them were a mess, more so than me. And when you have those scenarios, it's good to take all of that information and learn from it, so you do apply that to how you don't want to run your company. So how you want to execute. So just take all that in and start applying everything you've learned to date as to how you can execute. Apparently my clicker doesn't work. There we go. So, problem, solution, how do you stand out? Kind of covered some of this already, but when you're solving a problem, there's 3 things that matter in a pitch deck. Everything points to the 3 things, right? Same thing in a business plan, same thing, interrupt me if I just keep going too much and I'm rambling because I do that. But when you have a problem, that's your market size, okay? How big is your market? It's part of the problem. The problem that you're solving for is that market, right? When you're trying to figure out how to solve that problem, solution, right? That's proof points, team, product, IP, all those things point to the product, right? What's the competitive analysis? How is your solution better than the next guy, right? It's all under the solution. And the mitigation of risk that I talked about before, that's the team. That's how you stand out. Also, just FYI, how are you not gonna lose my money? And when do I get it back? Those are the 2 biggest questions that every startup founder forgets to answer almost every time. Hey, when do I get my money back? I don't know, when we IPO. Okay, but hypothetically, like, is that going to happen? Well, I don't know. I haven't thought about it. I just want to build the thing. You gotta do a little more than just build the thing. You gotta really think about these answers, which is why the business plan is important.
And so the problem part is interesting. A lot of people want to kind of skip over this, but this is sort of the crux of your business, right? So when we talk about problem, it's really about, does anybody care about this problem? Okay, step 1. Step 2, are there enough somebodies that care to make it a viable business and an investable business? You know, a lot of entrepreneurs come up with a business because they were looking to solve a problem that they had either at their workspace or, you know, something that said, I wish we had this, but it turns out only 5 people in the whole world had the same problem, so they didn't make it, right? You want to make sure that there are thousands or tens of thousands or millions of people that have that problem, and that makes it viable. Then it's worth the solution, and then you get to the standout part. It's really the third part. If you're looking for investment, you know, the investor wants to understand the first two parts, and then that investor might have heard 5 or 10 pitches of companies similar to yours. Why you instead of the other 4 to 9 people that they looked at in the past 6 months? What is it that makes you the person that I want to give money to? And the reality is, investment can be tough to get, but people want to give you their money. Investors want to give you their money. You have to give them reasons to do that, right? And that's what this process is all about.
Right, so they take the meeting because they're willing to write checks, right? So that's just facts. Very few people are going to take a meeting with you to waste your time. They're going to be more interested in, how you're going to solve the problem that they're already interested in, right? Also, just a good rule of thumb. Do not send an NDA, then send your deck. I will never sign an NDA when I'm looking to possibly raise for somebody. Send something that's not super protected, something that gets the gist across. If you send an NDA, you will not get investment. Very rarely will you get investment, okay? You have to get past that first hurdle of like, hey, I want to tell you what I'm doing, and then you send that, and then you get some idea of how to execute. At that point, when you're going through the pitch process, with that investor, you're like, hey, I'm willing to give you the secret sauce. I want to dive into the IP that we have, the patent more about the file, all of that stuff, but I need an NDA because they're interested. Okay, that can work. Won't always work. Usually only during due diligence will that work, at least with me, and most VCs. Angel investors sometimes, family offices sometimes, but just FYI, so you know going in, layman's rule, don't do that. I gotta stop walking forward, I keep walking forward. Back one. Yep. There we go. Okay, so go to market. So we talked about asking people, what their opinions were. We need data, right? Raise your hand if you know product market fit. All right, so those of you that don't know product market fit, let's just break that down. So you built a product, right? You think you've identified your market. So you think I'm reaching this age group, I'm solving that problem for this, gender, this socioeconomic class, etc. Right? Whatever the breakdown is. But what you don't know is whether it fits or not. Is the price point right? Are you marketing to the right group? Have you actually figured out whether they're going to tell their friends about it? Because product market fit means word of mouth marketing is happening on its own, right? That the customer acquisition cost is driven down to a point where it's just phenomenally good and you're going to make money on every acquisition. So that's product market fit. If you've hit product market fit, that's when you go into the next phase, which is the seed round to grow, right? Or to truly identify product market fit. So on estimated costs, so who knows what COGS are? Okay, COGS are customer, oh my God, I can't remember. Cost of goods sold, thank you. So cost of goods sold breaks down each time that you're buying having something manufactured, right? What that cost is, what the markup is, so you understand that's your profit margin, right? But then you've also got all of the staff costs, rent, all of the different, what's that? Overhead, all your overhead, right? So that all leads to the actual value that your business is. So you're looking for EBITDA, which is earnings before interest, depreciation, taxes, right? So, and amortization, thank you. So when you're actually at a point where you can identify your EBITDA and you can identify what your COGS are, you're probably close to a Series A, right? Because most of the time you're not able to figure that stuff out, especially at this stage when you're kind of figuring out how am I going to go to market? It's all wild ass guess, right? Sometimes people say scientific wild ass guess, which is swag, or wag, depending on if you leave the scientific out. But those are important. So I mentioned CAC and LTV earlier. So CAC is customer acquisition cost, right? It's probably the most important thing that you can point to when you're raising money, especially if you're past the pre-seed. Even when you're not in the pre-seed, you want to point out this is our estimated CAC, right? Because I think I'm going to spend $500 to get this customer. And they're going to stay with me, lifetime value, LTV, for 2 years. Great. $700 to keep them. They're going to spend $1,000 a year. Great. I made $1,300 bucks. I'm stoked, right? And I just have to spend $750 or $700 every single time I get them, right? So that I need to raise 700K to get X number of clients to be able to grow this business to a healthy business. Please give me 700K, right? That's a really easy sales pitch if you've already figured out the numbers. Not everybody has that, it takes time to get there. So you just have to have a plan in place, hence the business plan, right? You don't have to have like a 60-page business plan, right? I know I'm kind of shooting down your business plan numbers.
You know I don't write 60-page business plans.
There's like 20.
They're like 20.
Yeah. I don't even do those. So I do a pitch deck, right? I break down my business plan that way because I'm visual. And I'm also, if you can't tell, all over the place. So I have to do things like that to be able to make sure that I'm on the right track. So I use each slide as a component to break down how I want to break the business apart and what I want to focus on, right? And then I give that to John, and John fixes it, and then makes it ready for a bank, which is super awesome.
Industry knowledge. This is where you start to get into the analysis part. And so I just want to clarify, when we talk about business plans, when I do business plans, I think probably 50 years ago, a bank or investor wanted to see a 60 to 100 page business plan. And then 40 years ago, maybe it was a 40 page business plan. And then 30 years ago, it was maybe a 30 page business plan. People still want to read business plans, right? So the business plan part is really for you. So look at it less as a business plan and more as an analysis document. Well, so every time that I do a business plan for somebody else or for myself, what I'm doing is I'm analyzing these 9 or 10 things that we're walking you through, and I'm trying to kill it. I'm trying to find reasons through data that this won't work. And if I haven't killed it through that, then I'm assuming it must be viable, right? So part of that is your industry knowledge, right? Industry analysis. You know, you've got a great idea. I've got this thing, it's gonna be amazing. There are times when you go through an industry analysis, you identify leaders in the space, you start looking at what is going to happen in the next 3 to 5 years, and you realize that 5 or 10 people are already working on this problem for the past 5 years, and they've sunk $100 million into it. And so you're 5 years and $100 million behind, right? Okay, so what are you gonna do next? Is that gonna be the plan? No, probably not. You're gonna have to fix it. So when you hear the word pivot a lot, I prefer to pivot while I'm doing research and analysis. I don't wanna pivot after I've started up and sunk a bunch of money and time and taken people's money. This is where I'm pivoting. This is when I'm doing the research and starting with the industry, like what's going on in that space, right? Who are the big players? What are the things that are gonna happen in the next 3 to 5 years? What are the things that are gonna happen in the next 10 years? You know, who's my competition? And what's the industry growth projections? You know, if you get into a site, and the census is a great resource, the economic census, you get in there and it shows that your industry is projected to lose 5% a year for the next 10 years, probably something you don't want to get into, definitely something your investors don't want to get into, right? So this is the important part. So this is the start of killing your dreams, which is a good thing, right? Because the dream that you have right now is not likely to be the dream that you end up with when you get through the whole process, and that's a good thing, right? You want to get it down, you want to get data, so when somebody asks you, how do you know that? You can rattle off like, hey, look, this is a growth industry, not mature yet, you know, CAGR is supposed to be 25% over the next 3 years. Okay, great, right? If I go to an investor and they ask me, how do you know that? And I say, well, I feel really strongly about where the industry's going. I mean, it seems good to me. That's probably the end of the meeting, right? So know what is out there and know those numbers. And I can't emphasize this any more than just like, look, try and use the numbers to kill your idea. And if it survives that, go on to the next thing and try and kill it, and so on and so forth, until you've got something that really works.
So, totally agree. And we have him kill all our ideas. It's awesome. The thing that's super important is when you're going through that process, you want to make sure that you're not the only person vetting the process. Go talk to people. Go talk to your friends. Go talk to your family. And they're also going to be like helping you verify that that is the correct path for you, right? Because if you start thinking like, well, I think this person's wrong, right? I think that doesn't make sense what they're telling you. No, it means you're not conveying the thing simply enough. It means that you're not solving the right problem, or you're not addressing how you're solving the problem the right way. So, like, for example, one of the things I say whenever we're like working on a pitch for someone, would so-and-so's grandma understand it? My mom understand it, right? The answer is, most of the time, no. She would have no idea, right? We use terms like, I actually did a pitch today where I was helping somebody raise capital. I was working with the investment banking group, and I used the term, it's currently the gold rush. This group is selling the picks and shovels for that space. It's a great analogy, makes total sense, everybody understands what I'm talking about, and they got it. So there's another meeting. The goal is to get to the next meeting, to get to the term sheet, to get past due diligence. So you don't have to tell them everything up front in the first meeting. You have to be clear and concise and easy to understand each and every time you say something. Keep pointing at the screen like the screen matters. Okay, I'm gonna start and you get to go on. So market analysis, I actually love market. I hate all analysis, I love market analysis. Reason why, this is where you do the whole TAM, SAM, SUM. Anybody know what TAM, SAM, SUM stands for? Okay, so like 6 of you. So total addressable market is TAM, right? Serviceable addressable market is SAM, and then SOM is serviceable operatable market. So SAM is, where your playground is. So if you say home improvement, right? That's a $450 billion market. It's not a small market, might be bigger now. It's like 2 years ago, probably bigger. So you're looking at like the two biggest players, Lowe's and Home Depot, right? One's 80 billion, one's 60 billion. So that carves out a huge chunk of it. But that's not your SAM, right? Because you're gonna be playing in a different place. So your SAM is, I'm gonna be, let's say pavers. Okay, how big's the paver market? 10 billion, 20 billion? I don't know the number, but let's say it's 20 billion, right? You're not gonna capture $20 billion of the paver market. You're not gonna capture 1% of that probably. But what you need to figure out is SOM, and that's your serviceable operatable market. Right? It needs to be conservative, it needs to be thoughtful, it needs to make sense. Because you need to break it down in a manner that makes sense logically, so the investor understands how your brain works. Because that's really important to them. Because they're going to want to be able to reach out and say, hey, this makes sense to me. Because I like how you're thinking about this. That's great. You've identified with an investor, it makes sense. Right? You can also break it down that I think we will capture X in 4 years in your SOM. Right? So you can say it's going to be $40 million, $400 million, whatever the number is, because you have a partnership, you have a relationship, you have something that justifies this space, right? So like, let's say you have a relationship with this paper company, hypothetically as a relationship with, I don't know, a good retailer like Home Depot, right? They have access to a bunch of buyers, they have access to the right groups to be able to sell that through, maybe they have access to the Walmart Lawn and Garden buyer, so they're able to then move product. That makes them interesting. That I want to hear more from this person, right? So maybe they've never had an exit. Maybe they've never succeeded in the startup space. Maybe they've never done something and started their own business. But what they do have is they have the right connections to possibly succeed. So these are things that matter to overcome and mitigate that risk for that investment. And it's good for you guys just to go through that exercise anyway, so you can hold your co-founder, whoever's doing this with you, accountable. That's super important. Accountability is so important.
Sure, the TAM, SAM, SOM is, I think most investors, when they hear a pitch, will accept that as long as you can support your numbers, right? And I think as an initial way to look at, will this idea, have enough people to support it? Is there enough money out there to support it? And can I grab enough? Like, on its surface, I think that works just fine, right? If you do your TAM, SAM, SOM, you're like, man, I'm not gonna make any money. Okay, well, that was a quick and dirty way to kind of find that out. I usually like to get a little bit deeper if I'm doing an analysis, particularly if it's tech. Like, for me, TAM, SAM, SOM is too broad. and it makes too many assumptions. And John hates to hear me say that because John likes to do Tam Sam Song, throw it on the slide, put it in front of an investor, and we're off, right? Me, I wanna, this is where I spend most of my time. The census is a great resource because there's an economic part of the census, which a lot of people aren't aware of. But what I like to do is analyze maybe 5 cities that I think my initial rollout would be in, and then start building criteria in. Is age a factor? Is gender a factor? Is education a factor? Is marital status a factor? You know, pick all the factors that might apply, and you can kind of do this reductive analysis to get down to a specific number of people per city, and then, you know, you're taking a small percentage of that. I mean, for me, if it's something tech-enabled, how many of you all are doing something that's tech-enabled? I think a lot of us these days, right? And most things are tech-enabled. When it's something boundaryless like that, I usually say, like, look, in my first year in these 5 cities, I'm going to capture 1/2 of 1%, right? So I make it super tiny. I try and make it as small as I can, and then, you know, so when I build my financial model, I can say, okay, this is gonna work, or this is not gonna work realistically. So I dive a little deeper than that, but I think the bottom line is when you're doing market analysis, that you can throw numbers on a spreadsheet or on a slide, but when you start to get questions about that, you should be able to answer that. You should be able to say, well, this is where this data comes from, this is why I believe this is true. People can argue with you, that's fine. They can have a different perspective, but you should be well versed enough in the data that you have, that you've created, your TAM, SAM, or whatever you're using for your market, to be able to have a constructive conversation about that, right? And that's really what you want to get to, so you can have the next conversation with that person, with the money, right? So people tend to get themselves in trouble when they have cursory numbers or cursory understanding of numbers, and somebody asks a tough question, they go, well, you know, honestly, I didn't really think about that. I don't really know, right? It's good to be honest. It's less good if your honesty is like, I didn't think about that. Then your chance of getting another meeting are probably a lot lower, right? So this is part of why we emphasize doing the business plan, or, you know, as sort of an internal analysis of what we're doing, so you can answer those questions.
And again, each one of these steps is meant to like try to kill the idea, because the only thing you guys don't have more of is time. So you don't want to make sure that you spend a lot of time on something that's not going to make money or get investment. Or click the button. There we go. All right. So each one of these, we've mentioned that you should source something. Like you should cite some source, you should like do the research. Nothing is more true than this. This is your IP, right? So unless you're importing something at a lesser cost, which really isn't venture related, right? Unless you have exclusivity, there's only one manufacturer of it, it's ultra patented, you're the only distributor in the US, it's hard to raise venture in that space, right? So you wanna make sure that you have all of this broken down. So raise your hand if you know what unit economics means. Okay, so like 5 of you. So that's cool. If you don't know, totally fine. Unit economics is probably the most important term that's up here right now, right? And how it works, who the suppliers are, all that's great, but it all drives back to unit economics. How much does it cost to make the thing? How much can you sell the thing for, right? And then that widget that you're selling, how long is it gonna last, right? Not saying you should do this, because it's a very loaded term, but planned obsolescence is a thing, right? So if you're building a thing that's like a light bulb and it's gonna go bad in 5 years, but it could last 10, you know, explain all of that. Explain why you have that plan. Maybe you're doing a SaaS model around light bulb reinstalling, manufacturing around light bulbs. I have no idea. That's you to figure out. But you gotta have a plan, you gotta make sure it's clear and simple, you know, so that I can understand. Because I don't understand complicated things. My wife tells me that all the time. And then when you're breaking down your unit economics, don't forget how much does it cost to import, how much does it cost to make sure it's set up, what's the customer acquisition cost for that product, because that's part of your unit economics. If it costs you $10 to get the customer, and you're selling it for 20 and it costs you $10 to make it, you make $0. So you have to figure out all of that so it makes sense. And so that an investor gets it, because they're gonna give you a check.
And some investors, when you get towards the financial section, their first question is gonna be unit economics, right? Other investors don't care at all. But I've probably seen it more and more over the past 5 years where like, what are the unit economics of your product, right? So sometimes it doesn't make sense, but to investors it makes sense. Like, to me, the easiest analogy that I can use is, how much did it cost Uber to make that ride happen? How much did Uber make off of that ride? That's unit economics in its most basic form. And if you can answer that, and again, show why that works, you can satisfy most investors who ask that question.
Right. So just make sure that you're thinking about all these things. Again, this is another way to kill your idea. Like, you might have identified a problem, but it might cost you $100 to solve it every time. It costs you $99 to make it. You make it $1. That's not a good problem, right? So you didn't come up with a solution. You came up with a really expensive way to lose money. So, analysis. Again, it is an important word, right? Who are the competitors? The worst sentence you can say to an investor, or me, if you're pitching me, or John, if you're pitching John, is, I don't have a competitor. There are no competitors in this space. That's not true. It will never be true. Don't ever say that. It's bad. There are not people in the space today, right? Maybe. But there's people that could jump into the space tomorrow. Like literally tomorrow. Like you launch, next day, Facebook launches a competing thing, right? Or Home Depot launches a competing thing. I don't know what your product is, right? I don't know what you're thinking about doing, but if it's in tech, there's billions of dollars in tech. Those tech companies can launch immediately. I'll give you an example. Instagram was given an ultimatum when they were bought. The reason why they were purchased, because they grew so fast. The team was so small and they were given a multi-billion-dollar exit. It's like 2.3 or something like that. The team at 26. It's amazing. By the way, it was a video game company. I don't know if you guys know that. It started out as a video game company who had a chat engine in the game, which is crazy. And that's what made them get acquired, because they let that be public. So that's how Instagram started. Freaking nuts, great story. And Facebook bought them because Facebook was desktop. They didn't have a mobile solution. They were going to build a mobile solution, and Instagram started getting market share. So they bought them and they offered them a number that they were fine with. Fast forward a few years, Snapchat. Snapchat was offered to be acquired. And the acquisition price, the founder of Snapchat thought was insulting. So he went off and did his own thing. Snapchat does not have a huge market share. Snapchat is not a hundreds of ridiculous billions. They're barely at 200 billion and they keep losing costs and they do not make money every quarter. They have problems. They would not have problems probably if they were acquired, but then we'd have a monopoly, which is, another conversation. Twitter, again, headlines. They were offered to be acquired a couple of times. They went on, IPO'd, built their own space. Now, it's important to also note, none of these guys would have probably gotten approved on the acquisition when they were trying to acquire all these different companies. Because there is a monopoly law, it does happen, and all the competitors that are in the space are like, hey, you're gonna destroy me. Look at Spirit and JetBlue. That acquisition was stalled and stopped and stalled and stopped 3 times because the big 4 don't want a competitor. It would have given them a competitor, that's 5. But they were like, we won't be able to survive. So you have to know all the spaces that you're playing in. And you have to know who can jump in, like immediately. And so when you go into the conversation, you're pitching somebody, don't ever say, I don't have a competitor. Say, we don't have a competitor right now. Say, qualifiers are important, right? Nobody's doing this at this moment, but here's the people that could jump in, right? Here's the exits in similar spaces and why you should care. These things are really important to know, so you're not figuring it out after the fact and responding after the meeting, so you're missing all these key points. Everybody follow what I'm saying? Am I rambling? Am I good? Yeah? Thumbs up? All right, cool.
Yeah, so for competitors, it's important to be both honest and open-minded when thinking about your competition. I hear the terms direct competitor and indirect competitor a lot. Like the reality is they're all pretty much the same. Like anybody who has a problem they need solved is going to buy the best solution that they can afford, regardless of whether or not it was specifically made for them or their industry or their company, right? So somebody says, well, I've got, I don't really have any competitors, I just got these indirect competitors, so they're not a big deal. Well, I don't know, are your customers, potential customers using the indirect competitor? Yeah. Okay, well, they're a competitor, right? So, and sometimes the answer is sort of right in front of you, you just have to realize it. About 10 years ago, I was working with a group from San Francisco who was trying to solve a problem for lawyers. Lawyers need organization. Apparently, lawyers are terrible at organizing things, or so I'm told. And they were creating a competitor to, Rocket, Lawyer, and platforms like that. And they ran me through their pitch 3 or 4 times, and I kept coming back to something they said. They said, man, we just really got to get lawyers away from their yellow legal pad and pen. So I heard them say that 3 or 4 times. I said, say it again. And they said, we really got to get the lawyers away from the yellow legal pad and pen. I said, write that down, because that's your competitor, the yellow legal pad and pen. If you solve that, you're going to win this. And they're like, yeah, I don't think we can solve that. And they went back to San Francisco and did something else. True story. And they went off and did other things and had quite a bit of success individually doing other things. But had they continued down that path, that's what they would have been fighting against, the competition they would have been fighting against, and not really solving that problem, because lawyers still aren't really willing to give up the yellow legal pad and pen, right? So, which kind of leads into if you've got to convince your customers or potential customers that they don't get it, they're not the one that doesn't get it, right? So just be open-minded when you're talking about customers. It's really easy to say, I don't have any competition, or these are my 3 main competitors, nobody else matters. Those guys are indirect competitors, also they don't matter. Cast a wide net and really think about what it is that other people are doing to solve the problem that you want to solve, and go from that direction.
Mitigate. So, mitigation is like the #1 thing, or the story of the scale, right? Like when you're pitching, it's all about mitigation. And that's true whether you're raising money or you're selling a product or you're just trying to hire someone, right? You want to mitigate that guy's risk or that gal's risk from joining the team. You want them, and you want them to be able to say yes, right? How many times have you guys been in an interview and you're like, yeah, I don't know if I want to work for this dude, right? That happens all the time. Like half the time when I'm interviewing a client, or when I used to interview for a position, my first thing out of my mouth is, what's your runway, right? Because I need to know how long I'm going to be able to be employed. This is really important. Very few people that work for a startup or take a job with a startup, they don't think, and I don't mean this negatively, and I didn't think the first startup I had. I didn't know they had 12 months of runway. I didn't know I had to figure out how to get 1,000 clients in 10 months or we'd fail. I didn't know, because I was 26 and stupid. I was a teacher who left teaching to go do startups because the guy offered me double what I was making as a teacher, right? That's a no-brainer. My wife continued to teach, so we were semi-poor, whatever. So we went on, I did that was great. And I didn't even think to ask, and then 6 months in, we're doing pretty good. And he goes, hey, there's 6 of us. We had a Yelp competitor at the time. We ended up selling to Yelp, first exit, yay. But we had a Yelp competitor. And they call a meeting, 6 of us are sitting there at the board table. And the CEO at the time, not one of the better CEOs I had, slammed his hand on the table, started yelling and screaming at everybody, and left. And the board member was there, the VC that had invested in us. And he said, guys, look, we have 3 months of runway. We need another 500 clients, or we're going to have to beat Kenny. And I'm like, okay, goals, metrics, good, let's go, right? Had no idea, didn't know to ask the question. From that point on, I always ask the question, because I had, a wife and kids now. I'm like, how long am I going to be employed? If I kick ass, how long is this going to go, right? #1 question you need to ask if you're going to be hiring, and if you're going to be looking and working for a startup, but if you're going to be hiring, you want to make sure we're well funded, sentence comes out, or we've got a good relationship with our investors, or we've hit our KPIs the last 3 quarters, we're looking to continue that, you need to add to that value. These are sentences you need to say that are important. Not that we're at that point in the stage, but I think that's important. And when you're going through the org chart and you're doing the business structure, C Corp, LLC, all of that is important to have figured out before you go raise. If you're going to raise, and then I'm gonna hand this off, the C Corp structure, you can actually now get away with the Nevada C Corp. It's very similar to a Delaware C Corp. But if you're gonna raise in Silicon Valley, they still like to see Delaware C Corp. So those are important. LLC, member units, they're units, they're not shares. It's a different structure. You will have to convert at Series A. You can get away with an LLC for pre-seed and seed because you're not actually selling equity. You're doing a SAFE or you're doing a convertible note. But you will have to convert at Series A. And usually only an exited founder can pull that off, that structure. Otherwise you want to be a Delaware C Corp. So this is all good stuff to be thinking about. Or basically your first pre-seed or seed round, you're going to need to convert to whatever the VC tells you, whoever the lead investor is, which could be a whole nother thing about raising venture capital. But yeah, go ahead. You want to add to that?
No, I actually think you nailed that one. So.
Okay. All right. So we talked about what the investor gets, what they're spending money on. How many have pitched a VC before? Okay, got a few people. All right. So when you pitch a VC, there's two things they always ask: when am I getting my money back? What are you going to do with the money that I give you? All right. Super important. So you always want to make sure that you're communicating and breaking down all this. None of these things here say salary. Don't ever say salary when you're saying what you're going to spend money on. They know you're going to pay yourself. They know that that's true. You don't want to say salary. You want to say operations. You want to say marketing, some consultants. But if you say salary, like, hey, we want $1 million, right? 500K is salary. What? That sucks. I don't want to give you 500K for salary, right? I mean, just think about if someone came to you, think about your kid. If you have a kid, I have kids, I have 3 kids. If my kid came to me and said, hey dad, I want $500. Why? I want to buy a bike. Okay. You're gonna do something with it? Like are you gonna get a paper route? Gonna go, is there an investment return on this for me? Because that's how I treat my kids. And he'd be like, no, probably. Actually, no, he's actually all about making money right now. But that's not the conversation you want to have. You want to have a conversation of, we are going to build an amazing team. We're going to spend this much money on X, and that's why. Like you say, salary, that's always better. You want to break it down so it's high level, but you can dive into each one. And the financial modeling, 3 years is standard, 1 year is mandatory. Have to do one, right? You have to say what you're going to do with the money. You can even put in a secondary raise or several secondary raises. Like if you're on fire, if your startup's like on fire, you're like doing amazing. You're hockey sticking every single time you launch a product, you're just doing great. You could raise every 3-4 months. Super doable. I've actually been at those startups, it's really fun. But what you want to do is you want to mark those in there. Like, hey, we're going to raise another $3 million here because we're going to buy more product, right? We're going to raise 300K here because we want to make sure that we do this one event. There's a trade show we want to make sure we have a good sized booth at, and all of that. So that we're going to hit these KPIs to justify that, right? That's all important to put when you're breaking out your financial model.
Sure, you're going to get ample opportunity to explain how you're going to spend somebody else's money because they're going to want to talk in depth about that. But what I usually do is in an executive summary, I have 2 columns. I have a column on the left-hand side, which is fairly small, that has pertinent information, name of the company, name of the founder, contact information. I put these bullet points in there, use of funds, and I break it down like that. I never let anybody read through 20 pages of a plan to get to financials to see how I'm going to spend their money, and I don't wait until the 8th slide of the pitch deck to do that either. Put it right up front in the exec summary so they can quickly see it and say, all right, this person is not going to spend 80% of the money on salary or whatever, right? They don't have the word salary in there. Also because people see lots and lots and lots of pitches, right? Or even the pitches they don't take, the stuff comes across their desk from their data room. The exec summary and the deck come across their desk. And some people see 20, 30 a day, right? And you couple that with the fact that people's attention spans are a lot lower these days. put that right in the left-hand column. Okay, I can see who you are, here's your company, here's the founder, here's what you're spending my money on, here's what you're asking for, you know, here's any traction we've got so far. And in the middle part's 3 paragraphs bragging about yourself, who you are, why you're important, and you know, why you're the right fit for this. And that's how I do that.
Right. So when you're breaking that down, first he's right. Like, I bet for 2 different family offices, or we bet for 2 family, it's not just me. We bet for 2 family offices. The time that we spend on the deck is like 5 minutes max. So we'll go through. We like one-pagers because it's super easy. We like deal memos because they're quick. But if we like it, we'll go through a deck, right? We want to make sure that like we understand it. I like decks like this that don't have essays on them. I like one-pagers that have essays, but they're very clear, concise. They make very clear points. Like the whole writing instrument of an outline is your friend. Use an outline. Super helpful. Because if they're motivated to like talk to you, they'll reach out. They'll send you an email with some questions and be like, tell me about this, and then you've got them. You just need to make sure it's compelling for your answers. There we go. So I mentioned this a couple of times. So convertible debt, equity, and debt, right? So equity is what we call a price round. Everybody know these terms, by the way? Anybody not know these terms? Like in fundraising? A lot of lack of participation, but I appreciate that. All right, I'm gonna go ahead and explain. So equity is a price round, right? So I think my company's worth $10 million, so every 100K is 1%, right? Super simple, not more complicated than that. Convertible note is a debt note that converts to equity, right? There's 2 different vehicles for that. How many of you heard of safe documents before? Okay, safe document is a secure agreement for future equity, right? Usually there's a discount. Minimum is a discount. The maximum is a discount, cap, and an interest rate. Interest rate's new in the last 2 years. I haven't seen it before 2 years ago. Maybe it's been around forever. My first one was 2 years ago. And then debt. Debt's you go to a bank, get an SBA loan, right? Or you go to a financial institution, they give you a check. So these are the things that you have to be thinking about how you're gonna raise. If you're gonna go down these paths, they have different requirements, right? So debt has very specific requirements. You need to be able to make sure that you have collateralization, you have justification, you have some sort of thing that you're gonna be leaning against. Convertible doesn't. Very similar to equity where they're buying in. The reason why investors like convertible debt is because they can write it off like a normal debt instrument. So it's actually a benefit to them, right? On equity, they're riding the ride with you. They want to go up the hill with you. Equity, most of the time, pre-seed and seed, they don't do it. So just be prepared for how you're going to be structuring this. Okay. You want to chime in? You good? All right. Go ahead. You like that.
So yeah, so the title of this slide says it all. The odds are long, and this shouldn't discourage you from seeking investment. Shouldn't discourage you from, you know, looking for investors, talking to investors, asking for intros. You should do all of those things. Just be aware that there's a time commitment for this, because out of every 100 startup deals that a VC considers, 1 in 4 is going to end up in a meeting. Like John said, we'll look at stuff, and it's 5 minutes, cursory glance. You know, John will look at something, he'll send it to me. The entire email, the body of the email will read thoughts, question mark. I will read it. Because I'm the optimist of the group, I'll just say terrible. That'll be my response. And which isn't really true, but we're looking for certain things, and so are investors, right? So the investors are looking for the same things that we are. So 25 will result in a meeting with a VC or any investor if you're looking for funding. 10 will lead to an additional vetting. So out of those 25, 10 out of those 25 will get an email back saying, hey, I have some more questions. Here are the questions, or would you like to have a conversation? Half of those will advance to an intensive due diligence phase. 2 will exchange term sheets, and 1 deal will actually be executed. And that's because out of those 2 term sheets that are exchanged, most of the time it's the startup that says, yeah, I don't like the terms of this deal. which is very fair. You should not ever take the money to take the money. You should make the deal if it's the right deal for what you're doing, right? So, but we've got from 100 down to 1. So part of the point of this slide is, looking for investors is a time sucker, right? You've got to go out and research and talk to people, and it can take you 6 months to get to a no, right? Or 12 months to get to a no, right? Even if you're going all the way through this process, you're talking to people, and they're thinking about it, and they're asking you questions, and you have meetings, and there's follow-up, and there's back and forth, and that's a long time, and you could be out there selling what you've got to customers. So you have to be able to judge whether or not, the time and effort is worth what we're gonna get out of this, or maybe I should just be working on selling, right?
Totally. So just to build on that real quick, we'll jump to the next one. He's totally right. These numbers might actually be conservative. I remember the first startup that I actually personally raised for, I had to reach out to like almost 600 people to get the first check. It was a really good idea at the time. Anyway, the point is, each time that you guys go through this step, you're gonna get a thicker skin. Super important to be able to get rejection, handle the rejection, go through that whole process. Because what happens if you don't is you're just gonna quit. And if you quit, well then you weren't meant to be an entrepreneur. And it's good to know that anyway, right? But you gotta be able to take the rejection. It's super important. I'm gonna skip to the next one because of time. So each and every time that you guys go and do this, there's certain things that you need to make sure you're doing. So when you go and you start doing raising, you go through the whole process, a professional deck, every Google Slides, free, Microsoft PowerPoint, they all have rulers, right? Use the rulers. If I'm going through a deck and nothing lines up and the titles are all off, you don't care enough to do that for me, why would I care enough to read it, right? Grammar. Like, by the way, I'm dyslexic and I have ADHD if you have not figured that out yet. So, I know that there's Grammarly, I know that there's ways to spell check, I know that I have John that can read all the things that I miss. If I don't have all of those things, then yeah, sure, I get it. But then you don't have a co-founder, which is a big red flag for me anyway, right? So these are all things that matter, and you have to be thinking about that. A data room. Data room is probably one of the most important things you can do when you raise, because all of your stuff's sitting there in a Google Drive folder, so that we know that you've been able to organize everything that matters, so that you have everything together. So when I say, hey, can I see your data room? And I know that you have all of your documents, your loan documents, you have your contracts, your letters of intent, your whatever XYZ thing, it's all there, right? All of the IP is there. It's super important for each piece of that to be organized and curated, so that we know that you care as much about your business as we do about our money that we're thinking about giving you for our business, for your business. Does that all make sense? All right, a lot of lecturing.
Everything John said is true. I think, speaking of deck and data room and everything, I'll take a step back. I joked previously that, John will send me something, my one-word response was terrible. And it's not really true. John sent me something today. It was a deck biomedical startup, and the entire crew was all MDs, which is sort of a red flag right there, right? So when I said terrible, what it really means is, they are approaching this like doctors would talk to doctors in their deck, and not how doctors would talk to investors, right? So yeah, there are a lot of companies that we take a look at, can we help them? Yeah, we probably can, right? If they're open to constructive criticism and some coaching, absolutely. But it's, if they went before an investor, I can tell you, because I have that biomedical experience, some biomedical experience, that I understood approximately 1/4 of what was on that deck. The investors, unless they have deep biomedical experience, unless that's what they invest in, they probably understood about the same thing. Deck was all words, it was charts, it was stuff that, if I'm a medical professional, I'm super interested in that. If I'm an investor, just get me through the end of this deck. right?
Keep it simple,
Yeah.
right? And the whole thing is about keeping it simple. You don't press the button. Oh, there we go. So I'm gonna blow through these because we're running out low on time, and I want to make sure you guys, if you have questions, you can ask. And feel free to raise your hand for the rest of this if you have a question. So, doing research. Anybody know where to find VCs besides Sand Hill Road in the Bay? Cool. Where would you go?
So PitchBook is good. I use Crunchbase a lot and try to narrow down what their ethos is and who would be in my industry, and then LinkedIn, and then as well as I attend conferences like TechCrunch, Disrupt, Merge.
Perfect. So so all of I was just going to add AngelList. The only one on there that's probably outside of people's reach is PitchBook. 27K a year, I think now. So that's probably outside of the realm, but the rest of them are phenomenal. Even Crunchbase, the paid version, is like $500 a year. So totally worth it. You want to make sure that you are doing your research to make sure you know the audience, right? It's just like sales. If you're going to go sell somebody something, you want to make sure you're selling to the right people, knowing your demographic, right? So if you're selling or you're pitching your company to an investor, angel investor, VC, etc., and you're a green energy company, and you're pitching to someone that only does consumer IoT products, probably not a fit. In fact, they probably wouldn't even respond to you, right? So just know what you're doing because your effort matters. Buttons. All right, so this pretty much covers what I just said. You want to make sure when you're doing the research, like for example, there's evergreen generalist VCs. Anybody know any of them? Anybody? No? I feel like Bueller right now. Sequoia is great. Sequoia has a huge team of analysts, Greylock, Andreessen Horowitz, A16. They're generalists. They have 1,000 employees. They're focused on making sure that they have as many different investments in as many different verticals that are trending at a double-digit CAGR, so that they are capturing the markets that are actually mattering and that will actually grow over the next 2 to 3 years. Right? So you want to make sure that you're doing your research.
Yeah, well, John's doing that. I'll just say that those were 3 great resources. Those are my go-tos. Like, there's a lot of free resources out there you can use to find investors. If you're willing to get a little creative, the information's out there. PitchBook is tough. Most startups don't have 27K a year to get a PitchBook subscription, so you can quickly and easily find them. But like Crunchbase and LinkedIn, fantastic resources. The Crunchbase especially has a section where you can actually click on. It'll say like, here are this company's main competitors in this space. That's even more information, right? It'll say like what their investment was and who invested in them. Even better, right? So, you can find a lot of information for free. It's, but it's that classic startup thing. You don't have money, but you've got time, right? Hopefully. So you got to make a trade there.
So basically, every single time you get a no, ask why, right? I mean, you can't get better if you don't have data. If you just get no's, you'll just keep doing the same thing. You shouldn't do the same thing. You should always iterate, but you have to ask. And you should do this with sales too. You should also ask when you offer a job and somebody says no, why not? Because you have to improve. This whole thing about startups is about making it better each and every single time you do something. Because if you're not adapting and iterating, well then you're not growing. If you're not growing, how are you going to be responsible with somebody's money, right? It's not yours. You got to be fiduciarily responsible. The only way to do that is to make sure you're the best possible person you possibly can be. Hit the button. You got it.
Okay, asking for feedback. I think John just hit on this, but find out why they're interested, right? That's important, but what their concerns are. And I can tell you, there are always going to be concerns. There's never been an investor meeting where a VC says, I have no concerns, your startup is perfect, here's a check, right? There's always going to be concerns. Hopefully through the research process, the analysis process, which is the tough and sometimes boring part, you have the answers to mitigate those concerns, right? Yeah, let's see where it takes you. Sometimes you're gonna get the additional questions for due diligence, like let's have another meeting, or I've got these follow-up questions. Sometimes they'll just say, look, I'm really not interested, right? But ask if it's okay if you can send them updates. And even if they say no, send them updates anyway.
Yeah,
Right?
every VC, everyone you pitch that like is willing to write you a check, you wanna make sure you put them on your email list for updates. I advise 9 companies currently, right now, where I'm on their advisory board, and 2 of them just hit me with, I'm running out of money. And I'm like, what's your investor list look like? Right? Are you updating these guys constantly? And the response from both of them was no. Why? You just got all this PR. One of them was on national media at CES, and he didn't tell an email like newsletter like, look at this just happened, right? So he drafted one, and he didn't just tell me. This was back in May. So when he did that in May, and he said, hey, I forgot to send an update. We've been so busy this quarter. Here's all this. He raised $300K just from that newsletter, from all the people that he's already pitched. So my advice is whether they say no or yes, they say no now, they might not say no later. So you need to make sure you're updating them because they want to see that you're progressing. And yeah, the VC might get less of your company. They might not care. They want to make sure that they're de-risking their investment, hence mitigating the risk, right? Did I go 2 or is that 1?
Oh, no, that's 1.
All right, sweet.
Yeah, that's us. There's our QR code.
That's us. So, questions? Yeah, we covered a lot really quick.
Yes.
Yeah.
Warm introductions versus cold.
Oh yeah, so warm introductions are better, right? I mean, so let's be clear.